Welcome to The Explainer. Today, we're tackling a hidden danger, a kind of invisible threat that can bring down even the most successful-looking companies, liquidity risk. Seriously, for anyone in the financial world, getting your head around this concept is absolutely critical. So let's just jump right in with a pretty startling fact. A company can have assets that are worth way more than all of its debts combined and still go completely, utterly bankrupt. I mean, let that sink in for a second. This isn't just some theory, it's the real story of giants like Lehman Brothers back in 2008. They had billions on their balance sheet, but they collapsed because they simply ran out of cash. So this brings up a huge and kind of counterintuitive question, right? How on earth can a company that's solvent on paper fail so spectacularly in the real world? It just feels like a paradox. Well, the answer isn't about how much you own. It's about how quickly you can turn what you own into cold, hard cash to pay your bills right now. It's a problem of timing and speed, not just overall value. Okay, to really grasp this, we need to think about what keeps a business running, day to day. And that brings us to this core idea of liquidity, which is best described as a kind of financial lifeblood. So what is liquidity? Put simply, it's all about speed. It's how fast you can convert any asset you have into cash. Think of it as the constant flow of cash that keeps a company breathing. Without it, everything else, no matter how valuable it is on paper, just grinds to a halt. And that, right there, is where liquidity risk comes in. It's the danger that this financial lifeblood suddenly runs dry. It's the risk of not having the cash on hand to pay your debts when they're due. And when that happens, clients can panic, and that can create a classic run on the firm, as everyone scrambles to get their money out all at once. Now, what's really interesting is that this risk isn't just one big, simple problem. It actually has two distinct faces, and they often interact in some really dangerous ways, kind of feeding off each other during a crisis. On one side, you have asset risk, and the question here is pretty straightforward. Can you sell your stuff quickly without having to slash the price? Then, on the other side, you've got funding risk, which asks, can you actually pay your bills on time? See how they're connected? If your assets are illiquid, hard to sell, you might be forced into a fire sale, selling them at a huge loss just to cover your immediate funding needs. So the crucial point to remember about asset risk is that not all assets are created equal, not by a long shot. I mean, trying to sell a massive commercial building during a market downturn is a totally different world from selling a government bond. The market conditions, what kind of asset it is, and how much time you have to sell it, all of that plays a massive role. All right, so if this risk is such a huge deal, how do financial professionals actually measure it? How do they check the health of that financial lifeblood before it's too late? Well, one of the most common external signs is something called the bid-ask spread. It's simply the gap between the highest price a buyer is willing to pay for an asset, that's the bid, and the lowest price a seller is willing to accept, that's the ask. And this chart is a fantastic way to see it in action. A market with super high liquidity, like for US Treasury bonds, has tons of buyers and sellers. So that bid-ask spread is tiny, almost nothing. It's really cheap and easy to trade. But an illiquid market, like for certain junk bonds, has a wide, expensive spread because it's way harder to find someone to trade with. A wide spread is a big warning sign. Okay, so understanding the risk is one thing. But how do firms actively work to prevent a liquidity disaster? Well, it takes a really solid plan of action. One that's built long before a crisis ever shows up. Because this is so complex, there's no single magic number that tells you if you're safe or not. Good management starts with a really deep dive into the company's cash needs, forecasting all the money coming in and all the money going out. And beyond just watching market spreads, they use internal numbers like the current ratio or the even stricter quick ratio to make sure they have enough liquid assets to cover any short-term debts. This deep analysis all leads to a very structured process. First, they forecast their cash flows, and then they stress test them for worst-case scenarios. Second, they analyze all their funding sources, pinpointing high-quality liquid assets they could sell in a heartbeat. Third, they build what's called a funding matrix to see potential shortfalls over different time periods. And finally, and this is the most critical part, they establish a contingency plan. This is their emergency playbook, prearranged credit lines, a clear list of which assets to sell first to minimize losses. The goal is to act decisively, not to react in a panic. So, the big takeaway here is that liquidity isn't some static number on a spreadsheet. It's a dynamic flow that demands constant vigilance and proactive management. And that leaves us with a final and pretty important thought about the complex financial world we all live in. If this is the invisible system keeping everything going, just how healthy is it really?